January 22nd, and we are at the NYCERS offices at 335 Adams Street, Suite 2200. And Diane, if you would please call the
Here.
Here.
Controller's office.
Here.
Public Advocate's office.
Here.
Borough President Manhattan.
Here.
Borough President Brooklyn. Here. Borough President Queens. Borough President Staten Island.
Present.
Borough President Bronx.
Here.
National Brotherhood of Teamsters.
Here.
Transport Workers Union.
Happy New Year. Here.
District Council 37.
Here.
Thank you. And before we get started officially, I would like to introduce our newest trustee to the group, Earl Phillips, is the financial secretary and the treasurer of TWU. And I'd like to say a little bit more.
Good morning, everyone. Happy New Year. It's a pleasure to be here and be on sitting on this board and share some information and come up with come up with the right pensions for folks, working class person. Thank you.
Thank you.
Thank you. Thanks. Welcome. We actually have one request for a change in addition to the agenda. As the first item, DC 37 has a request, and if no one has any objections, I'm suggesting that we hear that first.
Thank you, Madam Chair. Just wanted to give the board notice. My organization, District Council 37, is out of its building at 125 Barclay Street. The building suffered extensive damage as a result of Hurricane Sandy, and it's a long, lengthy process to bring that building back online. We have almost about 900 people, close to 1,000 actually, people that actually work in that building who have had temporary space around the city. One of the things that we as an organization wanted to give the heads up to the NYCERS board is that we would be interested at some point in time, subject to its availability, to negotiate with NYCERS for the temporary lease of their space in Long Island City. We understand that that space is now being used by teachers' retirement system, but if and when that space becomes vacant, District Council 37 would be interested in speaking with NYCERS, and it would be subject to negotiation with NYCERS and subject to the approval of the board for the temporary use of that space until such time as our building at 125 Barclay Street comes back online. We're not sure when that may be. It's months and months down the road. So I just wanted to bring that to the attention of the NYCERS board. And thank you for your consideration in this matter. And thank you, Madam Chair.
Thank you. So let's move into the agenda. The first item, Larry, is the November monthly performance review.
Okay, since we haven't been together for a little while, let me just give you some quick market comments and then get to the November numbers since we're midway into January. I guess you may recall there was a lot of volatility in the summer. At the end of the summer, the ECB said they were all in, which meant that there became calm in the European sovereign debt markets. Right after that, the Fed said they were going to extend their low interest rate policy to the middle of 2015. Those were two very, very good things for the markets and eliminated two very big risks, particularly the ECB. The next risk that got eliminated was the election of the President of the United States. We all know Barack Obama got reelected. Sort of in the month of November, there was a lot of volatility about what that really meant, but by the end of November, the volatility basically went away. The next event that had to be dealt with was the fiscal cliff. Fiscal cliff has now been broken into two pieces. The tax piece, which was resolved in the first week of January, and now we have the second piece, which deals with budgets, and the debt ceiling, which is sort of March, April event. The combination of those five things, actually the four good things, has led to a lot of relief in the markets despite a little bit of volatility in November. So as we pick up our ball sort of from July 1st onward, the markets have generally gone one direction, which was upward being good. At the same time, the economy has generally drifted upward at a slow pace, actually too slow for the Fed, which also announced in the middle of that rather than have a date in mind, they'd like everyone to focus on their agenda, which is a combination of employment levels, which they said they'd like to get down to 6.5% before they lighten up on the monetary policy, and keeping inflation to reasonable levels, which they define as about 2.5%. So if you jump to page 39, it was a lot of volatility in the month, because again, the first week or so was who's going to win the presidential election. The second couple of weeks was, oh my gosh, look what happened. And by the time the fourth week rolled around, everything was fine. So if you look at the top block of numbers on the left-hand side, you see basically the U.S. equity markets went nowhere. A little bit of going up in the European markets in the next block. But generally, if you run your eyes down the far left-hand column, you see that pretty much no runs, no hits, no errors, with a little bit of positivity to the numbers. If you then roll forward to the next month, which is December, on page 40, things started to get much better. And this is a theme that actually continued into the first 3 weeks now of January. So you see the U.S. equity markets again on the far left-hand block, up anywhere from 1 to 3%. European markets up 3 or 4%. That means people lighten up on their treasuries, which is the next block. But in general, things have gone very, very well. So very well is manifested on page 41. So in the month of November, where things really didn't go very far, we made about 1%, which is the far left-hand column. And again, we made money in virtually every asset class, which is great. And if you look at the fiscal year-to-date numbers, this is 5 months. We're up 5%. We should make 1% every month and then just close up the shop. That'd be great. And I would tell you that the early December numbers look like we made, again, 1%. So we're probably up 6% for the first 6 months. And January's been spectacular. We're up probably 2%. But again, it's early, and you got to make your numbers every month before you get to a fiscal year. But for the first 6 months, we're up at least 6%, which is good. And again, all the asset categories are pretty much positive. So things are good. If you look at our asset allocation as to why we have such good results, I'll get you to page, let's look at 35 for a second. 35 shows a consistent theme, which is we're over-allocated U.S. equities on purpose. We're a little under-allocated international equities, also on purpose. The private equity, we're getting toward the top of our range. And again, it's not like you can just trade out of the private equity range. But that's because our private equity funds are generally making investments, although in the last couple of months they've been net distributors of cash to us. In the fixed income, we're at the lowest end of the ranges on very high-grade stuff like Core Plus 5 and TIPS. We're a little bit over the range, or at least it looks this way, in November. That's now back in the range if you were to look at it today. But pretty much, again, we're long U.S. equities, which is good when equities are rising, and we're long the highest yielding debt securities, which is probably the right thing to do also. So all in all, we haven't changed the asset allocation since our last board meeting. Markets are headed up. We're making money. Things are all good. And that's the month of November with a sneak preview of December. Any questions?
I have just a quick question. Excuse me, as I'm fairly new to this board, I noticed that we have had in the past, and I'm seeing on page 42, a current violation of the investment policy where the TIPS allocation of 2.9% is below the adjusted target range of minimum of 3%. And at other boards that I've been involved with, the boards have typically seen some sort of a compliance reporting, which shows whether or not the plan is in compliance with the board's stated policies. And so while we do see this on a monthly basis, we're not actually seeing a full compliance report of all of the other policies that the board has put in place. And so I wonder if that's actually being done by someone on a quarterly basis, by Callan or some other outside firm, and it's just not coming to the board, or is that not happening at all?
Well, let's see where to start. So we have a few people on our staff that are in charge of compliance. The compliance is generally with our managers,
Right.
and they review quarterly reports quarterly. And where there's not compliance, they go back to the managers and say, hey, you're not compliant. So we monitor that regularly. In fact, last year, I think there was an outside group that came in and tried to tell us that they do it a certain way, and then we went back and audited our compliance and found that we were 99.9% in compliance with what they wanted to sell us. So I think we do a very good job monitoring what our managers do. As to the asset rebalancing ranges, Martin and I sit down once a month officially, but we monitor it weekly to see if we're out, over, or under, and if we're over or under a range, we discuss rebalancing as well as where we think the markets are going. So, for instance, we wouldn't necessarily rebalance for 0.1 if we thought the markets were going to adjust it for us. Otherwise, we're kind of sort of being a day trader on the edge. So for tips, for instance, you'll find that we're in compliance now, not having sold anything, just because of the way the markets were moving. And again, we monitor it, I'd say, weekly to monthly, depending on the markets and how close we are to the edges. So we try to anticipate if the markets are going up in something that we look like we're toward the upper end, we'll start a discussion ahead of time as to what we're going to do about it. So, for instance, in high yield, Martin and I have sat down numerous times, have spoken to numerous of our managers as to what are we going to do with our high end of the range position in high yield, say. Are we constructive on high yield? Do we think it's temporary? What do we think about the Fed? How long will it take us to do it? Where are we going? Because again, we do it more of on a plan basis than weekly day trading around ranges. But if we see ourselves approaching a range, we'll make an investment decision as to how to handle it. And then if it turns out for a period more than a couple of weeks, if we're over, we'll put in place a plan to get us back under the ranges. So that's what the assignment is.
If I could clarify really quickly, Janice, the page she was referring to is 36 in today's handout, not 42.
Okay, so that's a good explanation of your process, Larry, for rebalancing the portfolio. My question was actually a little bit different. It was more along the lines of the comptroller acts as an advisor to this board in managing the day-to-day investment operations of the plan, and part of that role is to ensure that the plan is being managed within the policy that the board has put in place. And so much like the comptroller's office monitoring... Pardon me?
I think there's a question coming.
The question is there a compliance report that a third party is providing to the comptroller's office that the board can start to see that provides us with a quarterly picture of whether we're in compliance with our policies?
I don't know how your other boards work. There's no such requirement for such a certificate. So there is no certificate.
So there's nobody at this point doing any compliance with regard to...
No, as I said, we look at it regularly, but there's no, if you're looking for sort of a certificate or an audit or something like that, there's no document that says such paper is required, so there is no certificate.
Okay. So I just want to perhaps pose this question to my fellow board members. We can think about it and come back to it next month, perhaps. But part of our role is to monitor our advisors to whom we've delegated certain tasks, and it seems that we are doing a good job of monitoring our investment managers' compliance with their own individual guidelines, but we, at this point, don't appear to be monitoring the Comptroller's Office compliance with the board's policies and guidelines. So perhaps next month we can add an agenda item to discuss whether or not the board feels that it's prudent to start to receive compliance reports.
If I can comment just on that for a
Can I
second.
follow up first?
Sure.
Yeah, I reject this idea that we're not monitoring the comptroller's office. Now, we might miss something, but this whole idea that we're not monitoring the comptroller's office, I think, is quite frankly sophistry. We see them regularly. They give us everything, and you may end up being right on this particular point, but there's I don't think it's fair to have this idea out there that we're not monitoring them at all. I don't agree with that. I want to say.
No, and let me just clarify, I wasn't certainly saying that we were not monitoring them. I said it might be prudent for us to have some sort of a compliance report so that we are tracking the Comptroller's Office compliance with the investment policy statements.
That more narrowed down point, I can swallow a little.
Sure. Al, do you have a question?
No, I think there is.
Okay.
Yeah, I was
go ahead.
about to say that, since I've been here, which is this is my 4th year, we put this report together with the sole purpose of transparency and being monitorable. So, for instance, that simple chart that everybody now looks at and takes for granted, wasn't here before, is here before. The purpose is to know exactly where you are, to your point. I mean, you couldn't monitor it any better than have a chart that's in color with ranges that says, here's what the ranges are. So, I agree. I'm a little bit not quite sure what you're looking for, but happy to talk about other ways to do it. And again, we have outside auditors. We get audited. The systems get audited once a year, and I think we're not. I mean, there's been no surprises, so I'm a little surprised at your comment, actually. But whatever the board wants to do, we're happy to do.
Well, if I can interject, I mean, just that it's at the most practical level here, I guess the question is it the board's role? You're implementing, manager selection and everything else, combining the portfolios. But I see here, we're 30 basis points above the policy range, and it leads me to question, why do we have a policy if the board isn't enforcing it? Because we're in violation. And
Well, I would tell you that this 30 basis points is A, rising markets, and B, we did a transition, correct me if I'm wrong, Martin, right about here of the entire high yield portfolio in the senior loan.
The bank loans were in progress right at that time.
Right. So, I mean,
But we're still above the policy range, which I guess it goes back to the original question, why have a policy if it's not being followed?
fair.
Al,
Okay.
do you have a comment?
Well, I'd say a couple of things, and then I have a question. One is that I think the board has been, in my time here, fairly diligent about monitoring what's happening with our ranges. And when we go over them, we usually get some commentary from BAM about how we're going to deal with it. So I'm not comfortable with what's actually happening. But I think, to your point, I don't see anything wrong with the board getting a short and very concise, piece of paper telling us what is happening, so that it's not just verbal in these meetings. And I think that would be helpful for the board to have that prior to, an investment meeting where it's going to be discussed. So I don't see anything wrong with getting a report. My question to Mark is, what does the investment policy say about process when we go outside of a range? Does it say anything about process?
I would have to look. There's specific in it. Typically, what a policy would state is something along the lines of when assets flow out of policy range, they will be rebalanced as appropriate. I mean, it's generally open so that, in fact, the advisor, in this case BAM, is able to make the type of moves appropriate to make. I think I mean, some of this is, gets to how formal and detailed and outside the board may want something. But I think the issue of sort of whether there is current reporting that gets to the policy issue is here. And it has been here now for the course of the last year. Page 35 indicates, and this is something that was provided to the board ahead of time, indicates that enhanced yield is modestly out of balance at that point. I don't remember whether, in fact, as part of this discussion today, Larry indicated what the plan was or what action had already taken place to bring that back into balance. But typically, as part of the discussion, the commentary will be made that we were out of balance here, this is the plan, this is what we're doing, and so forth. And I think that flowed out of discussion that took place over the 2 years prior to this. My sense is over the last year that in fact, this is part of the report. The question is, do you need more than this as part of the report? I think it's at least pretty open at this point.
Okay. No, I was merely asking for us to consider it and add it as an agenda item for the next meeting, so we can take...
I mean, Madam Chair, if you came to the board with a proposal, it might move the process of working on that along.
Sure. Thad, do you have a question?
I'd like to echo some of the statements made. That is to say, we have the report on page 36, which is, like I said, I think is transparent, and Dan is always working to improve that and make it more user-friendly to the board. And I think what's also important is maybe some of the history that some of the folks may or may not have. And you look, for instance, when we had the market meltdown, we actually passed a resolution to allow BAM and working with the board not to sell during certain times of market dislocation. So I think if you look at the history of, quite frankly, Larry's tenure and even before that, we've always been very mindful of the board policies, and I think we've been open and transparent. And I think we welcome a discussion on that, but I'm not exactly sure what exactly you're looking for. But we're always open to improving things. But again, I'm a little unclear as to the point of the process that, in terms of the material you don't already receive.
Right. And to Al's suggestion, I will put together something for everybody to consider. And so thanks for that suggestion. And I didn't mean to take up time here, Larry, but we will bring it up at the next meeting. Pat, do you have something?
Yeah, I do. I was just thinking that if we were so, lack of a better word, rigid about adhering to the actual target range, if we were doing that in times, as Thad brought up, where the market dislocation was in effect, that might in fact injure the fund. Is that true, Larry? If we were that rigid, we could actually hurt ourselves?
Yeah, I think the way the IPS is written, in fact, I know how it's written, it doesn't say if you cross a line, you have to instantaneously react. It's specifically written for times when there's a lot of movement in the markets. It says you should develop a plan and work it accordingly. I can't quite tell you the exact words. I'm happy to send the words around. But again, you're supposed to operate within bands. There's an outside edge to every band. There's some flexibility given as to when and how and timing by which you get yourself back in the band. But it's all about sort of look both ways before you do something. And don't react to, if you're 0.1 over, don't just sell because it's a rule that you absolutely have to deal with. Because it does acknowledge that markets bounce around. Just like, we're going to be compliant by the time you see the January numbers, partly because the equity markets will have gone up. So you have this denominator effect. You didn't have to do anything, but your high yield bond is now a smaller piece of it. So it's a good conversation to have as to how you do rebalancing, but I'm sure, again, the IPS, which we read a lot, because that's where the rules are, it specifically is written so that if the market bounces around, you don't start selling stuff instantaneously to get inside a magical number, because markets do bounce around. But we'll talk about this some more.
Quickly, I just want to reaffirm, I think my sense of how things have worked in the past and appropriate policy is to have some degree of flexibility with rebalancing. I believe the Comptroller's Office has been always worked very hard and in very good faith and very diligently looking at rebalancing issues. But I also appreciate your point that your broader point about just seeing whatever we can do to improve compliance. So that's certainly not certainly a good point. So to the extent you bring something to the board, I'd be interested in learning what other systems are doing, as you mentioned in the beginning.
I'm happy to do that, and sorry to take us off track here, Larry.
Okay, so any more comments on the review, on the actual numbers? Okay. The second item, I guess I'll hand over to you, Al.
Okay. Madam Chair?
Yes, certainly, Al, you have a proposal for the board?
Yes, I do. And the Borough President wants to thank the Controller's Office for their helping in getting this on the agenda, and the Mayor's Office for getting this on the agenda. I'm going to try to be concise here. I think the board will agree that there's been a great deal of horror at some of the recent mass killings that have happened in the United States, and the weapons that were used to commit these heinous crimes were primarily assault weapons. And being a lot of us being parents, to see these children that were massacred was a horrible thing, and it makes you think. But then that's when you have your hat on as a private citizen. When you put on your hat as a trustee, you start to think about, well, is there something here that might affect any investments that we have in these kinds of weapons? And I think with a lot of the proposals to legislate the banning of assault weapons and high-capacity ammunition magazines, I think the board needs to try to get ahead of it to see if our assets that are in manufacturers of these weapons and magazines are subject to some kind of downturn in their value. And I think the purpose of this resolution is for the board to request the Controller's Office to conduct an analysis to see a couple of things. One, where we're invested in companies that are producing assault weapons, and two, a report on on what options we would have to minimize any loss that we would have in investments in companies that are producing these kinds of weapons. And I think this resolution is of the essence, and I think it's in accordance with a lot of things that are happening out in the real world. Although I'm not saying this is not the real world, but recently, as people will note, New York State passed a very stringent set of regulations on assault weapons and high-capacity ammunition magazines. There are numerous proposals in various states to do the same. And then there's just a general sense in the public that something needs to be done about this. And then again, there's the federal government. There might even be a federal ban on these weapons. One other thing I would say is, as you'll see in the book, there's another resolution which is being proposed by the public advocate, and I just wanted the board to understand that my office and the public advocate's office had several conversations about producing a single resolution, but we couldn't come to agreement on the language. And I think I don't want to. Steve will be able to characterize what he might think the differences are, but I think what this resolution is really going after is doing an analysis of our investments in companies that are producing assault weapons, not just guns. So at this point in time, this being a very unusual circumstance, I would ask the board to pass this resolution right now, with, of course, a chance for Steve to say anything that he wants to say.
Sure. Thank you, Al. I would say that if you look at the two resolutions, they are substantially similar. If you look at the whereas clauses, they're almost identical in some respects, at least substantively, with the main exception being that the borough president talks about assault weapons and ours talks more generally about the gun industry. We are fine with speaking solely about assault weapons, so there's no disagreement there. The idea, I think, of having two resolutions is redundant would not even be the right word. It would almost be, in some respects, not necessary. In some respects, almost pointless. It's particularly since, as I said, we're fine with the term assault weapons, so we're fine with that. The only thing I would like to see added, ours in the resolve clause calls for what I would characterize as a little bit more deference or a little bit more leeway to the bureau, to the controller's office, and specifically says, and other actions deemed necessary by the Bureau of Asset Management. I would prefer to see some language in there like that, just giving more leeway for them to do beyond just these two steps if they feel it's necessary to conduct a fiscal impact statement or other research they feel is necessary to be.
You guys have already talked about trying to include that language in Al's resolution.
That specific language, no.
No, this is...
Is that an amendment?
This is are you proposing an amendment?
Well, I think as a board, to come up with one resolution together really makes the most sense. To have two, just
it does. I think you're on the right track.
Yeah, absolutely. So we're here now. I mean, we're
open, of course, to amendments that make sense to us from the board.
John, do you have...
Sounds like he's outlining an amendment. I was just trying to get the language.
John, do you have a question?
I had a concern and a thought in comparing the two resolutions, and I just want to clarify, our position on it. I spoke to the borough president in detail, and his opinion and his thoughts on this matter basically were that while he does support his brother borough president's resolution, he has some concerns with the actual language of the resolution proposed by the public advocate, in that his resolve calls for the full divestiture before. He's calling for a full divestiture before we've had the analysis done.
Right.
And I think, the borough president said our fiduciary duty seems to be to do the analysis first and see the effect that will have upon the plan and upon the participants of the plan before we come to the conclusion. So we would like to see the analysis done, a report presented to us on what the results will be, and then the determination by the board if it will, in our fiduciary responsibilities, will be prudent to divest now or to divest at all in these issues. And since our obligation is to participants solely as participants of the plan, not in any other capacity, then we really have to have that stuff, that step done first. And that's where, our position is on it. So if some accommodation can be made to the language to incorporate that in, we definitely support it. But as it stands now, we support the Bronx Borough President's resolution.
And we do have the law department here, and I believe that, would you say that John's statements are consistent with our fiduciary duty as a board?
Well, if I may, before he chimes in, it reads, shall take all steps necessary to institute a full divestiture. And as I read that, it is to take all the steps, and of course if they come back and it shows that it would be against our fiduciary obligations to do so, then we would not ultimately divest from these institutions. That's as I read it.
Well, I appreciate that's not the intent of the public advocate. I think the way I agree with John on the way the language is written now.
And it even says before that, consistent with fiduciary obligations.
Yeah, but even with that, I think I agree. The language is at a minimum ambiguous. It suggests that there's a foregone conclusion to divest before the analysis. So I think if you're given your actual intent, if we were to go with some version of this, that I would agree that that language should be revised.
Well, again, it sounds like there's some consensus at least to do something, right? And again, I come back to the idea of having two resolutions. It just doesn't make sense. So let's get one resolution while we're all sitting around the same table. I know that I've had conversations with several folks here. I think Dave and I would like to set some conversations with folks as well. But now we're all sitting around the table. Let's get the resolution that we as a board want to get on the table. I'm sorry, you had your hand up.
That's okay. Janice?
Yes,
Yeah. Steve, the language, other actions deemed necessary by the Bureau of Asset Management is amorphous. I'm not sure what those other actions would be, if you want to explain them.
I don't know what those actions would be either, but to give the opportunity to give them, I mean, I would like to see a fiscal impact statement, for example, specifically, but they might come to a point where the two specific steps identified are not necessarily enough to make a determination. There may not be any actions necessary.
Well, the analysis, I think, probably would entail that as well. I would assume that would be part of any analysis that would be done. I think the Bronx Borough President's resolution covers about everything that's necessary. I'm glad you said that you would agree with that.
Yeah, absolutely.
Can I just add a couple of facts?
That's always helpful.
So my estimate, given the market's moves upward, are that NYCERS pension fund total assets are about $45 billion today. Today.
Could you say that again, Larry, please?
Yeah, the assets of NYCERS are about $45 billion, highest ever. And that our estimate of the companies that are publicly traded that are gun manufacturers is about $9 million. Of which about 75% are held through our holdings of indices, of equity indices. So we will go through the analysis of what would happen if you did a variety of things with those $9 million of assets inside a portfolio of $45 billion. So a fiscal impact statement might be, I'm sure we'll consider it, but it is somewhat small relative to $45 billion. So I think, and we'll also work with Callan to make sure that it's just not BAM's advice you get. You'll get ours plus Callan, as well as we're already talking to our managers, including the indices, as to what would happen if we did this, or that. So we'll come back to the board with a complete examination, as well as speak to council about the fiduciary responsibilities of boards, so that the next meeting will have a complete presentation. How you all word that is up to you, but I think we got the assignment.
Yes, sure, John.
And this is about the public advocate, the Borough President. Does your resolution anticipate also divesting us of investments held in the indices? That we have to change our indexes? Yeah.
That's an analysis.
Yeah. Well, okay.
You know,
No, but I'm saying, is your intent? That's what I'm asking. I don't know. It's the analysis to be done, but.
I think our intent is to minimize whatever risk is out there.
Fine. We'll look at the risk. If you had it, if you didn't have it, we'll go backward. Hard to go forward.
I know. If you could, it'd be great.
It would be great. We'd have no problem with the ranges then.
Ken, do you have a question?
Thank you. Stephen, I was trying to give you a chance to add a...
I understand.
Okay, I think this
I
train
wanted
is
to
leaving.
talk it out before.
The train is leaving, I think. I was saying, if you don't have some suggested language, I think we're going to go. Do you have other language?
Well, yes. I mean, like I said, I did want to add at least that language.
Okay, but where are you proposing it?
And which resolution are we looking at?
I think we're working on
Page 66.
Page 66 of this.
Okay. All right, so Steve, you have a proposed change to the language?
Sure. I would add a third
point.
Third point. All other actions deemed necessary by the Bureau of Asset Management.
All other actions deemed necessary?
By the Bureau of Asset Management.
Necessary for...
Actually, necessary to comply with this resolution.
To comply with this resolution.
Okay.
You find that friendly, Al?
Yeah.
Sure.
And just let me first ask, the process that Larry described for us earlier, that the comptroller's office is going to undertake, is everyone comfortable with that process? Okay. Okay, good. Yes, Inga?
I just wanted to point out that last week, the teacher's retirement system requested our legal opinion on this issue, and if that's something you're looking for, we're happy to do that by the next meeting as well.
Never hurts. Well, I mean, it seems like we would wait to ask for the opinion after we decide
That's
what we
fine.
were going to do.
That's fine.
That'd be part of the, whatever clause you just added, that's part of it.
Absolutely.
That's good, so I'm wondering what that clause meant.
Al, I think in part of our office, Larry, if I may, it's contemplated as part of Larry indicated the packaging material that we presented.
Very good. Very good.
And then can I just clarify, so there is a difference between the two resolutions with regard to firearms and assault weapons?
Well, since we're going with the Foxborough president, it's assault weapons.
Okay.
Yeah.
Do we want to include all firearms, or are we just focusing on assault weapons?
Well, I mean, if a gun manufacturer we're invested in is not making assault weapons, then I don't think they would be covered by this resolution.
Okay. And is that okay with you?
Yes.
Okay.
Fine.
Good. And Larry, you did say part of your process was to involve Callan Associates?
Yes.
Okay. So the change that is proposed is to add an item, a small Roman numeral 3, that says all other actions deemed necessary by the Bureau of Asset Management to comply with this resolution. Al, are there...
Actually, I have one minor amendment. In the caption, it says requesting the New York City Controller's Bureau of Asset Management. I would add the word to conduct.
Okay.
That's very
We're
controversial.
actually directing you. We're actually directing you to do something.
I don't want to go there.
Are there any other proposed changes to the Bronxborough President's resolution?
Can I make a motion
Certainly.
that we accept it as amended?
Do we have a second? Second. All in favor? Aye. Any opposed? Thank you.
Thank you very much.
Number 1.
Thank you.
Sorry, I have a follow-up question. I was thinking, and this is a thought I had, and also, I know Al had been thinking about this as well, is whether with this, the NYCERS should create some part of our investment policy statement that addresses how we would consider divestiture, from now on for any sort of situation, so it's not necessary to have ad hoc resolutions about major developments like this. Because I think the natural course of considering divestiture is through a rigorous financial analysis, as laid out by Al's resolution, and that should always be the case. So I wonder if it's would help the system to have even a basic outline of steps in our IPS about that.
And may I ask Callan if that would be something that is common of your clients?
As I was listening, I was trying to think. I'm not aware of any sort of process that is outlined that anticipates those types of situations. But I guess I don't really know. My first reaction, but I don't think that is that I'm not aware of anything in policy statement that sort of says when we are considering future steps, these are the types of things we might consider.
Well, I think it's the perhaps it's not appropriate, but I think it seems to me a distinct, not too uncommon situation where something happens in the world and there's a movement calling for divestiture. The last time that this hit our funds was with Sudan and Iran, and there was a rigorous process that was undertaken there. So perhaps there is some way to describe and classify this sort of situation, specifically using the term divestiture, to make it clear that, before we do that, a certain basic analysis has to happen.
And maybe the way to approach this is, because Jim might be right, but I think we need to figure some things out, is maybe within item 3 of the resolution, other items deemed necessary by the Bureau. Part of the consideration part of this is to look into that issue.
And Ken,
Does that work?
Ken, do you have a comment?
I think Jimmy's point is actually thoughtful. The things that I'm thinking about is what would be the triggering mechanism to start that analysis? How would you kind of craft language that would trigger the actual analysis?
Well, I guess
we come back to still.
Well, I'm thinking I may be wrong here. Maybe just prior to a categorical decision to divest from an entire industry or segment, something like that. I imagine that we don't encounter that type of decision too often, where we're deciding whether to divest entirely from a certain sector or asset class or something. So that's how I imagine it. Some sort of language, prior to, when considering divesting from blank, 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 something like sector, industry sector, etc.
I think CalSTRS has something along those lines, only because when I was doing the research for this, CalSTRS had their vote about 2 weeks ago, and I was speaking to somebody at CalSTRS about it. They sent me, and it was very easy for them to conduct their divestiture because they have something, some kind of divestment policy already set in place. So I think what you're saying, it makes a lot of sense moving forward. Depending on what it says, but certainly you can look at CalSTRS and see what it is.
John?
Actually, I think it's a good idea, Jim. For want of another term, I guess I'm referring to is the divestment policy statement. And maybe, since it's coming up new, can I request or suggest that our social, environmental, and governmental subcommittee take up the proposal to come up with some sort of divestiture policy statement that we can look at the board, because instead of doing it ad hoc, I think it'd be much better to have one.
Potentially, yeah. I mean, I think I'd be fine with the investment staff drafting it if they are interested in doing so, but if folks think the committee should look at other models like the CalSTRS is look at that.
Well, the reason I suggested that, Jim, is because maybe I'm anticipating things, but I think the areas of divestiture are going to come through the SEG issues in the future. So I think they should have a definite input into that.
Yeah, well, that's fine. But I think ultimately it's a divesting decision would be just straight financial analysis, regardless of. It could potentially come out of a Yes, but I'm fine. Yeah, I'm not against that.
Yeah, because I'd like to see maybe we talk about it. What is the triggering mechanism? Is it something that BAM would do and present to us? Is it something that we as a board would take up and present to BAM? Is it our investment advisor coming to tell us this is what we think may be a problem in the future? How do we trigger it? What's the process to go through it? And then what are the procedures before we have a resolution or final determination of it?
Yeah, perhaps the committee could come up with a draft and submit it to BAM if BAM is agreeable to that, for them to give input or tear apart or whatever. So I think the thing that I want to prevent is that divest any. And again, it's not with the gun issue. Just want to clarify, I'm not opposed to divesting there. I don't have any confusion whatsoever. So it's not that I'm against divestiture in any situation, but it's something that needs very rigorous analysis, and we want to make sure that any decision along those lines is not seen as a screen, sort of a social screen, which is not. Certainly there's social dimensions to the issue, of course, and that affects that has financial impacts. But so I think spelling out the basis for divestment decisions in financial terms is important to make clear. part of our basis for those decisions.
Well, the other point, Jim, is I think, and I didn't just I'll leave it on this, is I think it's a good idea because then it seems when we do take these things up that it's not a knee-jerk reaction to something that's happening in the newspapers.
Yeah.
That we show a thoughtful process going through. And that, as long as we stick to that process, we're complying with our fiduciary responsibilities.
How about if we do this? Since divestment is actually depending on the size of the position, it's extremely impactful to your portfolio. And take John's point that you could have, unlike guns, you could have philosophical issues with a variety of products manufactured by a variety of companies that we own. And it's not clear to me what's divestable, what's not, what's an important social issue, what's not. I think it might be useful if we had Callan start with a comparison of the top 10 or 15 public pension funds to see what their rules are. Just go through their IPSs and see how they deal with it. We're not creating something that's new. Divestment has been around for decades. Again, the board has come upon it 2 or 3 times in the last 2 or 3 decades, I think. So it's not like it happens all the time, but I think we shouldn't... I think it'd be useful to see what everybody else does because I think it's pretty straightforward, actually. And I actually think the way we do it here is fine. But if you want to write it down, that's also fine. But let's just look how our brethren do it and get to the answer because I think it's pretty straightforward, actually. So could that be all right if we have Callan just come to everybody and let's just do that?
So is the proposal to have Callan survey and provide that information to the committee?
Well, I don't care who it provides it to.
Okay. I think that's reasonable if everyone agrees. All right. Well, thank you, Jimmy. That was very thoughtful to suggest that. It was helpful. Thank you.
Okay. Next is that's going to lead a discussion on the basket funds, which is something we've discussed. Well, we started when we did the asset allocation a year and a half ago, so it's a little bit of a refresher course, but it needs some action items. So I think that's going to hand something out, or is it a book? Okay.
Page 70.
Over to you, Thad.
So on to page 70. As Larry indicated, this is in many ways a follow-up discussion. The board may recall that we adopted an asset allocation in spring of 2011, and as we worked into that, it was sort of the intent to seek relief from the basket as we worked into things like opportunistic fixed income, into hedge funds. So on the first page of the presentation, we have a brief history of the basket clause. I think the important takeaways in terms of the basket clause, it's a statute in the state's retirement social security law that not only NYCERS but your brother and sister funds in the city also work under, as well as the 3 retirement systems of state. So all 8 systems within the state of New York operate under this construct. And essentially what the construct says is that those investments that are not considered to be legal list investments are limited to a basket cap of 25%. And I think on the next page, page 71, it's interesting, especially the right-hand side of the page. You have this, I would tell you, rather long list of investments that are considered to be basket investments. And as you look at some of those, as we mentioned, hedge funds, bank loans, and non-U.S. equity above 10%, for instance, these are all things that the board has made decisions to work their way into. And as we've moved forward with our asset allocation, we believe now that the legislative session is starting now, it's a good time to come to the board and sort of memorialize that the board is supportive of moving to a increase in the basket. The recommendation in the book is to go to 35%. The following page, on page 72, we have a chart that you see every month in your packets. I think the key in this chart, again, is on the right-hand side of the page. sort of on this invested basis. Right now, we have remaining capacity of over 4%, and as Martin and Seema have worked with you, for instance, again, on opportunistic and hedge funds, we're moving more and more into those areas. And as other asset classes like PE, we also have commitments that we've made. So we think it is a prudent time to ask the board to seek approval to move to 35%. As many of you know around the table, the legislative process is not always an easy one and takes time, so we want to begin this process now. And if anyone has any questions about that chart or any comments anyone would like to make. If not, I will move to the following page, page 73. Sure.
How do we get to 35?
So what we've done is we've looked at a number of things, and later in the presentation we have some work from Callan. You may recall that when we first did our asset allocation in the spring of 2011, we looked at a number of scenarios, and part of it is based on past history of 35 as to where the legislature has granted relief in the past. For instance, we went from 15 to 25 in 2006, and we thought, given where the board wanted to move with their asset allocation and timing and such, that 35 was a prudent request. The next page is a representation of some of our peers and indication of some folks who have what we would call restrictions that are not, or standards that are not a prudent person or a prudent investor. I think the takeaway here really is sort of more on the following page. We look at those states that do have certain types of prudent person exceptions. The restrictions, if you will, in New York seem to be much broader than many of our peers throughout the country. So the need for us to get the basket relief, I think, is very important. So, as I said on the following page, page 75, the recommended request of the board is to essentially be on record as we move forward in speaking to our peer funds throughout the state, as well as to your brother and sister systems here in the city, to approve an increase, to pursue an increase of the basket to 35%. And I'll turn it over to Bud and to Mark as to some of the work that they had done in terms of our asset allocation and the risk and return profile.
I'm really going to concentrate mostly on the memoranda that's in the book on page 77 and 78. Be happy to sort of talk about the analysis, behind it. But I think to our mind, there's a couple of things as BAM first came to us and told us they were thinking about presenting this at the board meeting and asking for our views. I think as a broad statement to start with, we think that expanding or at least examining and getting the opportunity to expand the use of basket clause investments is both appropriate and good for any fund. Any limitation, any specific limitation, robs you as a board of your flexibility, of your ability to diversify further, and so forth. And so just as a broad statement, the idea of allowing greater diversification through expansion here is of the basket clause investments is we think a good thing. That doesn't necessarily say that I wouldn't then make the jump and say we're right now recommending that you have 35% in basket clause. It's simply saying let's allow the flexibility, and I think that's the first statement. I think the issues that they come down to on this memoranda essentially get to a couple of things to keep in mind. For those of you that were on the board at the time, you'll remember the asset allocation work we did. When you do asset allocation optimization, there is little difference that you see as you necessarily change asset allocation. So in other words, if we showed an increase in the basket clause from 25 to 35% use, what we show in terms of projected returns, projected risk, etc., are relatively small differentials. And that's because of how asset allocation works. The real issue to us gets down to the issue of, as we talked about, diversification. And so the key points that we think are important in this are really at the bottom of page 77 and 78. First of all, as we talked about, the decision on asset allocation is unique to every particular board. So your ultimate decision, if you get the expansion to 35%, is going to be then based upon do we agree with the reasons to change our asset allocation? That we're not approaching that at this point. What we're really approaching is the philosophical question itself, and that we agree. I think the important thing, though, is bullet 2. And that is the economic diversification is another way to take a look at this. If you'll remember, one of the key components of the asset allocation work last time around was that the public equity risk of your portfolio reduced significantly. It reduced from 79% of the overall portfolio down to approximately 70%. So using the basket clause as much as we were able to do by introducing hedge funds, private opportunistic fixed income, a greater allocation to real estate, and private equity to a degree, was able to reduce your exposure to equity, your economic exposure to equity. Expanding the basket clause to 35% would allow you the flexibility to reduce that even more, but not to a significant degree. But still, that's one aspect of it. The other aspect, and this is a major one, is at the top of page 78. As Thad indicated, non-U.S. equity over 10% is currently a basket clause investment. You are currently artificially allocated low in non-U.S. equity because of the basket clause. Relative to your peers, you have much more domestic equity and lower non-U.S. equity because of that constraint. And so the ability to use non-U.S. equity, get the greater diversification that comes from that, would be one of the potential benefits of this. And the very last point that we make is, while we don't project added value from active management on the part of managers, nonetheless, the areas of basket clause investment are in fact the areas where active management makes the most sense. And so by restricting your investments in the basket clause, you at least reduce your opportunities for either outperformance or underperformance, with a nod to our actuary, on the part of active managers. So I think for those reasons alone, the attempt to expand the basket clause to 35%, and then the board makes their own decision about what asset allocation should be, but the ability to expand that is something that we strongly support. So we would be in favor of that effort on the part of Dan.
Yeah, let me just add a couple of comments. So again, we spent probably 8 or 9 months going through asset allocation in the leading up to the board approving an asset allocation in, I think it was June or July of 2011. And in doing so, kind of embarked on a journey. And at the time, we looked at the longer-term journey, which is okay. So we change the asset mix, we get more diversified, we're trying to lower the volatility, keep the returns about the same, which as was just pointed out, we sort of agreed to and we're implementing. Implementing being increasing our opportunistic fixed income, our private equity managers, our real estate, adding hedge funds. All those things are kind of in process, and let's say we're sort of, I don't know, some percent through it, more than half in aggregate. But while we did that, we also looked at what I'll call, that was the medium term. We looked at longer term scenarios that got us to 35, because as Mark correctly points out, there's just some rigidities that are baked in the basket clause structure that make you sort of, instead of zigging, you have to zag just because of the rules. So they kind of get in the way. So if you glance at page 90 in the book, you can see at the bottom of the very, very bottom, it has remaining capacity, so that under the guidelines it's about 4.5%, and under the actual, it's about 4%. And again, we have investments to be made in all basket clause items, that being opportunistic fixed income, more private equity, more real estate, and more hedge funds. And if we actually keep going, we're merrily approaching zero remaining capacity. That's all well and good as long as we don't have, as Pat mentioned before, the markets go down, and then we're going to get a denominator effect. So at some point, sooner rather than later, we're going to have a constraint put on our investment performance and put on our investments by the limit of the basket clause. And again, if I go back in history, we approved the thing in the medium-term and the longer-range concept. In June, we were going to go, called the summer of June, we were going to go the following spring to Albany to try to change it, but at that time we were also talking about some governance changes, and we were going to hook it on to the governance changes that had to go to Albany. The governance changes didn't happen, but this kind of got stuck. So we didn't do this last year like we were supposed to do it. So here it is a year later, and we're really going back to the beginning saying, hey, we didn't do this, we should do this. So again, I would tell you this is something that the board tacitly agreed to, or not tacitly, overtly agreed to do back in June, July of 11. And since the state legislature kind of meets once a year, these are kind of annual decisions that we're slowly, if we keep punting it down the road, we're going to wake up one day and say, gee, how did we get to this strange place, which is the basket clause is now in our way. Which is why when we were talking about it, Thad and I and the people in the controller's office, the answer is, well, this is a big lead time item. You should get the boards to reapprove it so that we can then go and figure out, which is something I have no clue, how to get this done in the state legislature. That's why Thad's in charge of this particular project.
And I think the important part of that is working with the various stakeholders, like the folks around this table.
Mark?
I guess, Larry, I just want to confirm also on page 90 that you referred to, where you're showing currently still about a 4% room in the basket clause. If I'm not mistaken, that's based on the adjusted policy. In other words, the board actually approved a longer-term policy that, for example, opportunistic fixed income is at 5%. There are other investments that are higher. Real estate, for example, is at 6%. In our asset allocation work, we actually used up virtually all of the 25% basket clause. And so while you currently have 4% room, the asset allocation policy that the board has already approved uses up close to 25%. And so the room you actually have is even a little bit less, quite a bit less than you talked about.
To your point, it's actually much less because we have, these are the assets in the ground.
Right.
So we have unfunded commitments for private equity and real estate and opportunistic fixed income, which, again, the commitments are out there. They can pull it down. We can have some combination of strange events happen where our managers pull down our commitments, which is perfectly fine. We like that. At the same time, you have the portfolio shrink because of the denominator, and we could just find ourselves in an odd spot. So I would say, again, we sort of agreed to this before. We should just re-agree to it and kind of move on and let the legislative process take as long as it's going to take. But
Larry, thank you for bringing this to our attention again. In the time on the board, I remember having discussions about this under the prior administration on the basket clause. So this is not something new, and it's not something there. And there seems to have been, I don't know, some, I don't want to say recalcitrance, but inaction on this issue for a number of years. And I think something has to be done on it, and I think we are constrained. And I would like to see either the basket clause increase to 35%, or one of the other things I think we discussed a long time ago was changing the definition of what's in a basket clause, where it says, change private equity to be similar to real estate and say private equity in excess of 10%. It means it's in the basket clause. Or hedge funds in addition to 5% as an alternative to saying go to 35. I would just like to put that out as an alternate proposal for the people to take up, so we're not limited when you go to Albany and when you go to the legislature to say, we want 35%, that's it. We'll take other alternatives that may seem reasonable and rational in terms of the situation. So if the powers that be are not happy to say that we increase the basket clause to 35%, but they say, but we can get them to say private equity less than 10% doesn't count to the basket clause, that may be a reasonable accommodation. So I'd ask the Bureau of Asset Management and its representatives and any other people who are on the table who are influential in that capacity to maybe take up that as an alternative proposal as well.
Well, Thad, you might update the board on what the New York State teachers did last time, similar to go to John's point.
I think as John points out, there's been some history here, and I think and having that on the record, John, of having the board give a sense to look at alternatives that will provide the relief so that, as Callan points out, the board can invest as they essentially deem appropriate is important. The state teachers, for instance, had a bill for a number of years to increase their real estate to 10%. There were also some definitional changes. So much that was in the basket for teachers and for common, a little less for us, which was considered basket, is now considered a legal list investment. So that's some of the history. Prior to that, in 2006, the basket was increased from 15 to 25, and then in the 90s from 7.5 to 15. So certainly I think the direction the board is giving is that that's where they're headed in terms of having conversations with the legislature as to various ways to provide that relief is important. How we arrived at the 35 is through, I guess, some years of chatting with people and looking at the history and in some ways I hesitate to use the word easiest, but I can't think of a better word at the moment. That in looking at what's that? Practical. Practical. Thank you.
That's controversial.
That's why he's the boss. So you know, in terms of changing one number from 25 to 35 and using a construct that legislative leaders and the folks are used to, sort of is how we sort of arrived at this approach. But certainly direction from the board to seek relief in other ways is certainly welcomed, and look forward to working with everyone on that.
And Pat, do you have a comment as well?
Yes, thank you. I'm thinking back to an event that I attended many years ago in Albany in February, and Tom DiNapoli was one of the speakers, and as you all know, he's the New York State Comptroller, and he wanted to have the basket clause increased. And as I looked around the room, I saw that people's eyes glazed over because they haven't a clue as to what that means. But and many legislators were sitting in the room at the time. But remember now that the state legislators are part of the public employee pension, the state's public employee pension. And I think that's why I would like to see us bring in others, particularly the Common Fund and the Comptroller and the New York State teachers into this, because strategically, I am a lobbyist. Strategically, it makes the most sense to have self-interest as part of this, because they're going to retire at some point, and everyone cares about it. Maybe when you're 25 you don't, but as time goes on, the pension becomes something that you really focus on. So that's just my comment on that part of it, to include others who have the same interest as we do for our people.
Pat, absolutely. We couldn't agree more. I think our approach, we've had some informal discussions over the years with the state teachers and the folks at Common, and our approach here is to sort of get the respective boards of trustees here in the city on record and then continuing that dialogue as we move forward. But you couldn't be more correct in terms of what we think our approach should be.
Ken?
Does John or Thad have language on kind of the alternative way of approaching this problem? Do you have ideas about language?
I just threw it out there when I
It sounds
read it out the other
thoughtful,
day,
but
but I just didn't want to. My thought was just not to limit BAM with the direction to get us 35% and to say that's it, but to get a sense of the board and how they feel to say if there are other ways to get us to the goal line, let us do that. We just don't have to pass. We could run that.
No, I got it. Is there language that gets us?
Yeah, I think.
If I might, Pat, if I might talk about
Can I
what...
just address Pat's question for 1 second?
Sure,
Madam
sure.
Chair, if that's okay? I was thinking that should we get to the point where the board wants to give us the direction to seek that relief, the language that I might suggest is approving an increase to the basket to 35% or seeking such relief or amendments to the retirement social security law that will allow us to implement our asset allocation as the board deems appropriate. Because there's a number of areas there, certain things, for instance, international equity, that you could perhaps lift the cap, the 10% cap. You could move other assets out of the basket into a legal list. But rather than sort of name them, have on the record the spirit of the board to seek all options. And obviously, as those conversations move forward, we would keep the board informed. Does that make sense, John?
Well, I might just share what's happening at some of the other boards. So at some of the other boards, what we've asked BAM to do, in light of very similar comments to John's, is to go back and come back to the board and educate us on what other options are available that might be viable. So, for example, we don't want to go to the state legislature, ask for 35%, and then the next year say, we have an asset allocation where we actually need 40% in the basket. We want something that is going to last for a certain period of time, so we're not going to have to keep going back to the legislature every time we want to make an asset allocation change. So we've asked Larry's office to go back and provide us with an analysis of what the range of alternatives are that we can consider, what we think is the best approach given where we want to be going forward, and then provide us with that additional analysis before making a decision. Because at one of the other boards, we decided that we didn't actually have enough information based on this analysis to understand what all of our other alternatives are and how they're actually going to get us to the place that we want to be. So that is in progress. So we may want to table this until we have that further analysis that BAM is doing for a couple of the other pension boards of the city.
I don't think that's quite the correct characterization, because if I remember right, two of the boards have approved this, haven't they?
So the fire board did approve it. The administration votes did abstain, and I think, in all candor and deference to the chair, who was not able to be at the police board meeting, we did defer voting on that. But I think it's fair to say, in my estimation, that the police board had they taken a vote that day, would have approved moving forward with some sort of legislative relief. I think we were laying that over at police in deference to the chair.
And did we have consensus at the teachers?
We had not brought it to teachers, Larry. We started with police.
And at the fire board, while it was passed with the knowledge that BAM is going to come back and bring an analysis back to the board for consideration and perhaps a revote. So it wasn't, let's just go forward with the 35%. It was, let's approve it today and then bring a further study back to the board to examine.
So, Janice, I would respectfully disagree with the notion of a revote. Other than that, I'll accept your comments, but I would respectfully disagree that the fire's intention was to have a revote.
Yes, Pat?
Yeah. Well, understanding that this could be brought back to us if there's, the desire, obviously, for more analysis. But I can see it would be done with 35%, and then you come back in a year and say 40. Now, the other part of this is the legislature never likes a bill to be introduced late. That's anathema to Albany. They like you to work it, and they like you to be up there peddling it from early inception on. And then everything pretty much happens in June, 3 in the morning, whatever it is. A lot of bills go like that at the very end of the session, but you have to be there earlier with it and talk to folks and go around and talk to basically everybody, not just legislators, but staff, etc. So I'd like to move it today, and then clearly whatever is necessary to flesh it out more to make everyone feel comfortable, that's fine, and bring it back to us. That you don't have a problem doing that.
No, if you'd like to make that in the form of a motion, I think we'd be very comfortable with that, Pat.
Yeah, I would like to make a motion to pass the what would we call this, a resolution to pursue increasing the basket clause from the present 25% to up to 35% for alternative investments.
And if I could add a friendly amendment, just to John's point, while also seeking or reviewing other options as may be appropriate. Does that work for you, John?
I'm okay with that. I'm kind of torn, to be honest. More information is always good, but at the same point, I understand the mechanics of the process, and I know that in reality, what we do as a board and what the other people, the other boards do, is going to have to be in conjunction with other boards throughout the state, common and teaching, whatever, and that it's going to be a long process to do that. So I am mindful of that process, and I think that the sooner we start, the better as a result of that. But I certainly have no problem with BAM presenting us with alternatives in the future. We may want to change that, but I think I'd be comfortable going forward today with that vote. So I would second it.
Oh, great.
Was there further question, Ken?
No, I was going to second it.
Okay.
I would say this, though. I thought that the comptroller's office, through Thad, their explanation to John seemed to kind of reach your concerns about the researchers. Thad started that off about talking about how they had thought this was the best way to approach it. So to me, that indicates some kind of thought around the questions you asked. And I'm also happy to get additional information. I think you should call it a question.
Okay. Yes, Pooja?
I have a question. So as the motion stands right now, we are going to be approving with the increase to 25 to 35% with the condition, or I guess with the condition that at the next meeting, then we'll bring back more analysis on the other options that John had raised as well as you had raised with a possible revote?
I think the resolution should be unconditional, but we'll keep bringing you back information because, as John correctly points out, there's a lot of different ways to slice this. We're starting with what I'll call the easiest, which is change 2 words. But, in the conversation, whether you can... One word. Well, it's a hyphenated word, maybe.
Okay.
But there's different ways to slice it. I mean, to the extent John's 100% right. If you can get some of the stuff taken out of the definition, you get to the same place. It's all about getting room. But you got to be able to move the ball. You got to get to first base, which is start the dialogue, start to be able to talk to New York State teachers, start to talk to New York comment. And as Pat said, the legislative process, of which I know nothing, all I know is it takes a long time. You just got to start. Otherwise, we're going to miss another year, which is not the right outcome. So I take your point of I guess we should vote. But it's unconditional to your question. It's sort of an unconditional vote. We'll keep talking about it.
And at least my theory, as we always have, if something comes along in the future that we think is better, we can always vote on that. As a better process, a better alternative, another approach.
Yes.
Just tactically, my question is, how does the lobbying process work? If we approve something here today, does BAM rent a bus, go to Albany tomorrow, or is that next week or next month? I mean, it's January, things happen in June.
Yeah, but
Is it even appropriate or helpful to have board members help BAM do some of the lifts on this? I don't know. I'm just throwing it out there.
well,
Pat's more experienced than I am, so I would...
yes, of course. Yeah, absolutely. The parties that are interested and everyone around the table, of course, if there's positive remarks made about it, I'll be in Albany. I certainly would say something positive, no question about that.
Well, maybe that would be appropriate, or perhaps off the record, to have discussions. Perhaps there can be some coordination of effort.
I think, right, that's clearly our intention, because there's so many stakeholders.
Right.
In order to move forward, we would need to do that.
Very good. So are we ready for the vote?
Yes.
And should we read, just clarification, read what it is?
Pursue increasing the basket clause from 25 to 35% for alternative investments plus consideration of other options throughout the process.
It's not just alternative investment.
Right, it's basketball investments.
Right.
Basket clause investments. Okay.
Okay, we got it. All in favor?
I have a question.
I just want to hear it read one more time. With the correction.
Okay, one more time then, Diane, sorry.
Pursue increasing the basket clause from 25 to 35% for investments plus consideration of other options throughout the process.
Sounds good.
Is that all right?
Yeah.
Okay, is all in favor?
Aye.
Any opposed? And I'm going to abstain.
I didn't add and beat them down on their fees, but I was thinking.
That's spirit.
All right. So we have one more, thank you everyone, we have one more item on the public agenda, and that is a presentation by, is it pronounced Series? Series? Oh, and here you are.
Madam Chair, do we have time for 5 minutes? Is the presentation going to be long or?
We have
Yes.
time for a 5-minute
You'll need
break.
5 minutes.
So
Okay.
11:20, please, and we'll start.
5 minutes might have been ambitious.
Okay.
7 minutes.
Such a long short.
Here, why don't you guys take them first? We'll get
Oh, yes. And so, if you would like to introduce yourself to the group.
I'm Chris Davis. I'm the Director of Investor Programs at NYCERS, which is a nonprofit based in Boston. We work with companies and institutional investors on sustainability issues, environmental, social, and governance. And with me is my colleague, Peter Ellsworth. And if you ask me any hard questions I can't answer, I'll give them to Peter. But I made brought a presentation here. Here, talk a little bit. How much time do I have?
We have 45 minutes, so if you want to plan on 25 to 30 minutes for your presentation,
I'll try.
and then to leave time for Q&A.
Sure. I'd love to leave time for discussions. I'll try to limit it to about 20 minutes. And some of the slides I'm just going to breeze through, but you can look at them at your leisure, and also I can make available electronic copies.
Al and I, just a quick background as a reminder, Al and I worked together to get the series here. As we brought to the past meeting, this ties into our work on moving forward toward a comprehensive ESG policy. So, I think series is the third of three essential leaders and experts to come speak with us. We had the Principles for Responsible Investment representative come about, 6 months to a year ago, and Jane Amish from Mercer, and Ceres is one of the leaders in the world on sustainable investing, particularly focusing on environment and climate change and ESG. So we're very thankful for them to come down, especially for this, to give us more education.
Well, thank you, Jimmy. It's an honor and a pleasure to be here. My talk is about incorporating environmental, social, and governance issues into investment decisions with a focus on climate change as a material investment issue. Again, series, as I outlined, focuses on sustainability, leadership in business and investment. The investor network on climate risk, which we're pleased that NYCERS is a member, and also the Comptroller's Office is a member, have been leaders on a number of aspects of sustainability and investment, particularly corporate engagement and active ownership issues. And Mike Garland is here. We work closely with Mike in the Comptroller's Office on trying to move companies on some of these risks and opportunities. Ceres does a number of reports on various issues of sustainability issues impacting investment, including one called the 21st Century Corporation. It's a roadmap for what it means for a company to become sustainable. We've done them on municipal bond issues having to do with water risks. Recently on the insurance industry, how climate change is impacting that industry, all of which can lead to material investment risks and also opportunities. So the Investor Network on Climate Risk, of which I'm the Chief of Staff, is I think we're 102 asset owners and asset managers now, including the largest pension funds in the country, CalPERS, CalSTRS, New York State, New York City, Florida, some of the major asset managers, BlackRock, State Street, Prudential, virtually all of the socially responsible investment funds, and what I call some of the green boutique investors. And we focus on climate and sustainability as investment risks and opportunities. My premise in speaking with you today here is that climate change and other key environmental, social, and governance issues can and do produce material investment risks and opportunities. I'm going to give some examples. And our conclusion, or what the takeaway is that trustees of pension funds need to identify and understand these ESG risks and opportunities in order to fulfill your fiduciary duties and make your funds sustainable over the long term, so you can pay the pensions that need to be paid many years from now in a challenging and increasingly complicated global economy. I hope you can see all this. Is this visible down there?
Yes.
Okay. So the fiduciary duty, it all comes back to fiduciary duty. We're not advocating social investment for its own reasons or to pursue values, but it's all got to be grounded, as you know, in your fiduciary duty. three principal elements of that. The sole purpose test, acting for the exclusive benefit of the beneficiaries, the duty of loyalty and impartiality to serve the interests of all beneficiaries, both short-term and long-term, and the duty of care or prudence, doing what a similar prudent fiduciary would do under similar circumstances, which includes diversification and monitoring of the performance of your portfolio. And our view is that material ESG risks and opportunities are a key part of implementing those duties. There was a report by the global law firm Freshfields about 8 years ago that was commissioned by the UN Environment Program Finance Initiative that concluded that in all major markets, including the United States, the duty of prudence allows and may require the consideration of climate change and other ESG factors in investment decisions. So what are some of the macro risks, the global drivers of ESG risk and opportunity? I mean, they're fairly obvious, but many of them have not been taken into account in traditional financial analysis to date, and in many instances still aren't. Population growth, we're going to be a world of 9 billion people soon, all of whom will need food, water, energy, and resources. There's also increasing affluence of the middle class, so people in developing countries are consuming more, which will lead to competition and higher prices for essential resources. Resource depletion, 2/3 of the world's population will live in water-scarce areas. By 2025, there's some analyses that show that we're consuming the world's resources at 1.5 times the ability of those resources to replenish themselves, which is not sustainable. Economic globalization, competition for resources, commodities, investments, markets are global. These risks are global. The biggest risk, I'd argue, is climate change. The recent extreme weather events, such as Hurricane Sandy, emphasize that. And then the world is more connected. Things happen quickly through social media. There's a real push for transparency, and news travels quickly and things change quickly. These ESG risks have significant bottom line impacts. Hurricane Katrina caused huge amounts of property damage in the Gulf, pretty much took out the Gulf of Mexico oil and gas industry for a while, which is a huge part of U.S. production. The Massey coal mine disaster, from inattention to safety issues, basically led to a huge drop of the company shares, and the company being taken over and their CEO and chair stepping down. The oil spill in the Gulf, the explosion of the Deepwater Horizon oil rig was nearly fatal to BP, led to a huge drop in their share prices and other dislocations. The business case for sustainability, there have been an increasing number of academic studies, and there's a meta-study by Deutsche Bank that came out last summer that basically, virtually all of the academic studies show that companies with high sustainability ratings have lower cost of capital, they're viewed as lower risk and higher upside, and a very substantial majority of studies show that companies with high sustainability ratings financially outperform market averages for a number of reasons. There was also a Harvard study in the last year that showed that companies with a culture of sustainability that had certain key characteristics, like 60 companies that fell into that category compared to 60 that didn't, that were low performers. The sustainable companies showed clear outperformance after 3 years and continued outperformance in the long term. So paying attention to material, environmental, social, and governance issues turns out to be a very good business practice, and we work with a lot of large companies at a C-suite level on these issues because the CEOs understand that that's the case.
Excuse me?
Yes.
The names of those companies, would you have them?
The names of the companies that Ceres works with?
Would they have the culture of sustainability that show the clear outperformance?
Yeah, they're listed in that study by Eccles and Seraphim, the Harvard Business. I mean, I can't recite them all. There were 60 of them.
No, I understand that.
But yeah, the appendices of that study do list the companies that and the methodology by which they concluded that they fell into that category.
All right.
Yes, Jim.
Ask a critical question. So this is an extremely strong correlation, but is there hasn't been any sort of definite evidence of causation between the sustainable practices and the strong performance or financial issues, or has
Well, I guess when you get up toward 89 to 100% correlation, you'd think that there's causation. I mean, there are good reasons to believe that these companies would perform better. They're more efficient. They waste less resources. They are able to hire and retain the best employees because people want to work for a good company that is not only making money but is treating the environment and people and communities well. I think these companies tend to minimize their downside risks of liability, of getting sued, of non-compliance with environmental labor laws. They tend to have higher cultures of safety for the workers, better working conditions. So I think there are good reasons to believe, whether it's causation or just a very high correlation. I mean, I'd argue that it's causation, and it makes a lot of sense, and it's kind of what you'd expect. And that good performance on environmental social issues tends to be a proxy for a well-managed company that's also good at its core business and is looking ahead toward how to continue to lead and be successful, and isn't just trying to maximize its quarterly share price. I'd argue it tends to correlate with a longer-term strategic sense as well. But I think the evidence is getting strong. So I think there's a misconception out there that investing, focusing on, and by no means solely focusing on, it's financial ESG or financially material environmental, social, and governance issues is what you focus on. I think there's an outdated misconception that any attention to these issues is social investing, which equals negative screening, which equals reducing your opportunity set, which equals sacrificing returns and therefore violates fiduciary duty. And I think mainstream investment professionals tend to make that chain of assumptions when they hear ESG or sustainability, and that's most emphatically not what we're talking about. It's not negative screening and reducing your opportunities. It's smart risk management and looking for new opportunities. Yes, sir.
Hi. This is fascinating stuff. Could you give us the name of one of the companies on the list on the Harvard Business School study?
Yeah, I believe IBM, General Electric. I would expect that Dow and 3M would be in there. I don't really have the list in mind, so
Thank you.
I start guessing. Okay, so in terms of focusing on climate risk, climate change causes a number of kinds of risk to companies and to other investment assets. The most obvious recently is physical risk. Hurricane Sandy wiped out a huge amount of infrastructure and also showed the vulnerability of infrastructure in this city. Regulatory risk, a price on carbon, regulation of greenhouse gas emissions. It's true in much of the developed world. It's true in Europe, Japan, California, which is the world's 9th largest economy, has a robust cap and trade system that is pricing carbon, which not only creates cost, but it creates a set of investment and business opportunities. Reputational risk, if a company is viewed as a laggard in managing its emissions and its impact. Supply chain risk. Supply chains are global. I'll talk a little bit about floods in Thailand, and fires and drought in Australia that have had significant impacts on various sectors. Competitive risk, if you're behind your competitors on these issues, not a good thing. And there's a sort of a new concept, sort of stranded asset risk, or the carbon bubble. Is all the carbon that's in the reserves of global oil, gas, and coal companies really usable? And water resource and scarcity risks are an increasing issue that's related to climate change. The physical risks of climate change, I'm not going to spend a lot of time on this, but basically the weather is becoming more extreme. You may have noticed things aren't, we can go from extreme heat to extreme precipitation and floods. In the year that there have been floods in certain parts of the country, in the year that we had Hurricane Sandy, we're still having a massive drought in the Midwest that's making the Mississippi River levels so low that they're having trouble getting barges down, which makes it difficult to move a huge amount of agricultural commodities. So the science is showing that climate change makes extreme weather events more frequent and more severe. Sea levels are rising for reasons I can't explain to you. They seem to be rising faster in the North Atlantic than other places. It's not good, bless you. And it impacts coastal cities and real estate. So more on extreme weather, but the number of temperature records in the last couple of years. I guess 2012 was the hottest year ever, which each successive year tends to be in the lower 48 states. We keep having new records. I remember it was 84 degrees where I live on the day in March last year, which is not normal and not how it should be, and heavy precipitation events. Hurricane Irene, which wasn't all that big a deal until it got to Vermont, dropped so much rain into these narrow mountain valleys that it took out almost whole towns because it sat there and rained a lot. Extreme weather events, 2011 and 2012 have been fairly extraordinary. I believe there were 12 extreme weather events that caused over $1 billion in losses in the United States in each of the last 2 years, not only in the U.S. You see the floods in Thailand that, again, I'm going to talk about. Australia seems to be going from, I think it was about 120 degrees Fahrenheit in places in Australia last week. They're trying to play the Australian Open tennis tournament. That makes it fairly difficult for the athletes. However, they swung from extreme drought and fire to floods where a lot of eastern Australia was underwater in 2011, and that caused a lot of economic disruption in the commodities that drive their economy. There's a map from our extreme weather report that focused on the insurance industry, but we've got extreme amount of tornado activities, which seem to have a longer season and be more widespread than they used to be. The drought, the heat wave, and its effect on agriculture, on crops. We also have Mississippi River flooding, Hurricane Sandy, the wildfires in Colorado. There's hundreds of thousands of acres on fire. These are scary events, and this is only with 1 degree of average global warming. We're currently on a trajectory that's degrees Celsius, which is 1.8 degrees Fahrenheit. We're on a trajectory right now, according to a recent World Bank study, of 4 degrees of warming, the effects of which are almost unthinkable. Insured losses in the United States in 2012, $58 billion. Hurricane Sandy probably had about $25 billion in insured losses and about $50 billion in total losses. These have been bad years for the property and casualty insurance industry. I believe by some measures insurance is the largest industry in the world. It's in a lot of portfolios and indexes. It's not doing so well. It needs to come to grips with climate change, the severe drought, so on. So industries that are particularly vulnerable to climate change and extreme weather. Agriculture, food and beverage uses a lot of water. The apparel industry uses cotton and fiber. Electric power, in addition to taking out your power grid and knocking down your power lines, your transmission and distribution, power plants are cooled with water. And if the water becomes too warm, if there's enough of it, you can't run a power plant, particularly a nuclear power plant. And they've had to power down or shut down power plants during the peak electric usage periods of the last 2 summers in various parts of the country. The insurance industry, as I mentioned, is highly impacted. Mining can be, if your mines are flooded. Oil and gas, a lot of their infrastructure is coastal, and also tourism and travel. Real-world examples. So we did a report last year on physical risks, physical impacts of climate change, which we did with Calvert Investments and Oxfam, the global economic development relief nonprofit. And just some examples of a couple of apparel companies that were significantly impacted by both the floods that compromised their supply chain, their ability to get cotton, and things like that. And also, if the weather's warm and you make winter coats, like the North Face, that your business doesn't do so well. Allstate is an insurance company that we work with. Their CEO is noticing that we're seeing a lot more severe weather and assuming that it's permanent, so that the models that property and casualty insurers used to rely on for their actuarial planning aren't valid anymore because the future is not the same as the past. It's impacting the reinsurers, and there's been a lot of attention to this issue. So one of the industries we're working with most intensively on climate change is the insurance industry. Here's what I'll call the unburnable carbon or carbon bubble issue that's been receiving some recent attention. There was a nonprofit that a couple years ago did this study that suggested that a significant amount of the carbon reserves of the world's oil, gas, and coal companies, as well as the sovereign wealth funds that hold a lot of these assets in some countries, that you really, those reserves contribute significantly to the valuation of those companies, on the order of perhaps 2/3, and that the International Energy Agency just gave this some credence in their annual energy assessment report this year, that no more than 1/3 of the proven reserves in the world of fossil fuels can be consumed prior to 2050 to avoid the 2 degrees Celsius temperature rise, which is about 3.5 degrees Fahrenheit, that's viewed as the where catastrophic climate change might start and what the world's governments agreed to ought to be the limit that we ought not to cross. I guess the idea is that at some point there's going to be regulation that prevents all that coal and oil and gas from being burned, or we may make the world unsustainable to live in and conduct business in. Many have read about Bill McKibben's campaign for divestiture of fossil fuel companies. He's focused on university endowments, but to some extent also on pension plans. So there's another divestiture issue. So I commend your looking into a divestiture policy for how to deal with these issues. And we agree that it's not as simple as divesting, and that's probably not the right solution, at least to an issue like fossil fuels for large institutional investors like this fund. But we'll come to, there are a bunch of things you can do to deal with those risks. And there's also an organization out of Australia that I understand is moving to New York next year called the Asset Owner Disclosure Project. And what they're doing is putting a spotlight on the world's pension plans and sovereign wealth funds and what they're doing to manage climate risk and to help solve this problem, calling for complete transparency and grading pension funds on how they're addressing these risks. So they're trying to focus more attention on this issue. So the carbon and climate risk issue is not going away, and needs to be addressed. Okay, so what are some things you can do, assuming you agree that these ESG issues pose material risks or can pose material risks? The first is something that NYCERS and the New York City pension funds have been leaders in for a long time and continue to lead in, which is corporate engagement and shareholder activism on ESG issues, filing shareholder resolutions to get companies to address some of these risks. Climate change, water scarcity, tying executive compensation to how these issues are managed. Mike and his colleagues have filed quite a number of resolutions on these issues and moved a lot of companies to both disclose and manage these risks, and we commend that leadership. Policy advocacy. The policies that govern things like greenhouse gas emissions or fail to do matter in terms of investment risks and opportunities. Currently, there's no global or U.S. price on carbon, although there are other places, as I mentioned. There was a global investor letter that our investor network signed on to this past year, calling on essentially the G20 governments to take policy action to put a price on carbon and to promote clean energy investments, basically to level the playing field, since fossil fuels are heavily subsidized, and calling on them to stop subsidizing fossil fuels on the theory that climate change is a material risk to investment, and it's got to be addressed. It's going to take a lot of capital to address that risk. We've been working pretty much since the inception of CERS and INCR on getting the SEC to require disclosure of material ESG risks, which led to their guidance in January 2010 on disclosure of material climate change risks. And there's an opportunity to advocate for responsible policies that address climate change, because climate change is the ultimate systemic risk to the world's economies and to investments that depend on them, to the companies that this fund and other funds invest in. So then there's the third issue, which is the hardest one, and the one that you are starting to address by developing an ESG investment policy, and that's responsible investment, integrating ESG information into investment decisions. Commend NYCERS on being one of the early signers of the principles for responsible investment. That incorporates a commitment to do this and to report transparently on what you're doing. And these are complicated issues, but not ones that ought to be ignored. So this is a survey of PRI members and sort of what how they're integrating ESG factors across different asset classes. Again, there's been the most attention, not surprisingly, to listed equities and the other asset classes, infrastructure, developing market equities, private equity, non-listed. It's fair to say European and Australian funds are ahead of most U.S. pension funds in addressing these issues in their investments, although we here are leaders, and particularly the New York City funds, are leaders on the corporate engagement, on moving companies they hold. And since your equities portfolio is so large, that seems entirely appropriate as a risk management and as an opportunity pursuit strategy.
The different shades of blue are the size of the pension funds?
Yes. Yeah, the size of the funds and other signatories. So the PRI includes both asset owners and asset managers, and there are a full spectrum of sizes of both in that organization. Corporate engagement, again, your fund and your sister funds in the city have been real leaders. We provide staff and support for something we call the Shareholder Initiative on Climate and Sustainability that Beth Garland participates actively as a leader in to provide support to asset owners and asset managers that file shareholder resolutions on sustainability issues. We track about 120 resolutions filed by our participating funds each year. Interestingly, nearly half of those, about 45%, end up getting withdrawn by agreement. Companies really don't like these things coming to vote at their annual meetings, and they tend to settle and agree to, in many cases, at least nearly half the cases, to do substantially what they were asked to do, which is a good thing. So the New York City funds to the Comptroller's Office filed 17 climate-related shareholder resolutions in 2012, and these have been significant in moving corporate America on these issues. One example is that the Comptroller's Office secured agreements from the major computer manufacturers, technology companies, to require their suppliers to issue sustainability reports. Sustainability reporting is very important because what gets measured gets managed, and it requires companies across a wide range of environmental and social issues to understand what their impacts are, what their programs and strategies are, and figure out how they can better manage those to drive value for their shareholders. So what opportunities are there in terms of what we call sustainable investing in both equities and alternatives? And I guess I'd say that the broad concept here would be investing in solutions to some of these global megatrends, the sustainability challenges that I started with. So in equities, I understand a lot of your investments are in indexes. There are tilted indexes that are constructed to mimic the same benchmarks, the MSCI World or whatever your index benchmarks are, that are tilted more toward more sustainable companies, or HSBC has an index that is tilted toward lower carbon, less less full of oil and gas, but designed to perform in essentially the same way. So there's a way to, I guess, invest less in the problems and more in the solutions while maintaining the same kinds of equity strategies. There are various ways to invest in clean energy and renewables, waste minimization and recycling. In real estate, there's increasing evidence that green buildings, LEED certified buildings, are tending to have higher value, higher occupancy, lower energy use, lower costs, and are tending to be more valuable. And there's a real trend toward those type of buildings. In New York City, have been strong national leaders in requiring buildings to be sustainable, to meet these certifications in new buildings. Infrastructure. The country has a huge need for infrastructure. Our current infrastructure, our highways, our bridges, our waters, our sewers are old in our major cities, notably New York. They're decaying. The subway system we just found is not equal to major flooding events. So there's a huge need for infrastructure, and that can be done in ways that are more efficient, more sustainable, more environmentally friendly, that take more advantage of natural systems than what we've built now. Water infrastructure is something we're working on in particular. You can either use water more efficiently or you can build huge new supply projects, which we think pose risks to the bonds that are used to finance them, or can if the water is scarce. It requires a huge amount of energy to move and pump water from far away. New York City has a wonderful water supply system that's largely natural. All your reservoirs upstate in the Catskills that flow here require minimal treatment and largely flow by gravity into the system, but that's not how it works everywhere. Southern California largely lives on water pumped from the Colorado River, as does Las Vegas and some of the other cities. The Colorado River is not going to have enough water for the cities and for agriculture.
But do they have a choice? I mean, there's no water in California.
Well, I think they have a choice in how water is priced is really important. If you subsidize and keep the price down, which is politically attractive, people are going to use more. If it gets expensive, people and businesses find ways to use less. So there may not be an alternative to moving water to cities. Also, Denver. There's a lot of water that comes out of the other side of the Rockies down in Denver from the Colorado. But in terms of building new supply, Las Vegas, I think, is one that's building a $5 billion new pipe, if you will, to Lake Mead, so they can draw lower because that lake is going down. That's probably not sustainable, and maybe Las Vegas could find ways to use less water and still maintain its economy. So I think there are ways to use water a whole lot more efficiently, and there's really exciting opportunities in investing in ways to do that. There are water investment funds.
I thought our water came from Canada, New York City.
I don't think so.
No.
I think it comes from upstate, largely the Catskills.
I read something similar a couple years ago. Lots of
The bottled water does.
that comes from Brooklyn. I've seen them by
But climate change is probably going to impact those reservoirs and that system as well, whether it's extreme precipitation or the possibility of drought. So you've got a great system that's naturally resilient, but you can't. It still has risk. Private equity. The asset allocation discussion was interesting to us. I think there are a lot of opportunities, and there's a movement by asset owners, pension funds nationally, to move more into alternatives, both to reduce the risks from volatile equities portfolios and to invest in opportunities for potentially higher returns. KKR has, and also Carlyle are developing sort of green portfolio strategies, eco-efficiency strategies. I think KKR has 22 of its portfolio companies that it has pursued aggressive energy efficiency, waste minimization programs that they've driven, I believe, $600 million to the bottom line, and they report very proudly in their annual sustainability report on that. They've seen value in investing in greening their portfolio and making their companies more efficient. I think that's a trend that we're going to be working with KKR, which has also been working with the Environmental Defense Fund on that strategy. So venture capital, clean tech. Clean tech has taken a beating. It's gotten a bad name. Various investors, including myself, have lost money on clean tech with the overcapacity, Chinese solar. The good news is they've driven the prices of renewables way down. I think there continue to be strategic opportunities in technological solutions, some of these programs. Fixed income, green bonds. The World Bank issues bonds that are financially equivalent but support projects that reduce greenhouse gas emissions and promote sustainable development all over the world. Sustainable forestry and agriculture. TIA Craft has put together a sustainable agriculture fund. Agriculture needs to be done more efficiently with less water, less petroleum, possibly less fertilizer, and still increase production.
Less corn.
Less
corn.
Yeah, well, maybe less corn. We'll see, at least in the U.S. this year.
Yes.
So examples of what we call sustainable investment strategies. These are members of INCR. Generation investment, I believe that's in your portfolio. It is a number of the larger pension funds. They've pursued the very ESG-focused stock picking, and they have done very well. They've outperformed their benchmarks. There's a UK-based fund called Impacts that has a U.S. business now that is invested in environmental themes, basically investing in solutions, energy efficiency, water efficiency, waste management. They have done quite well. So skill of the manager is clearly important in these active strategies. Parnassus, one of the SRI funds, they manage about $12 billion out in the West Coast. They have a fund called the Workplace Fund. I happen to have invested in. It focuses on sort of best companies to work at, companies where the employees are the happiest. Those companies have done better than their peers by and large. State Street developed a green bond strategy last year to try to get into the sustainable investment field. So there are various strategies out there. There are also separately managed accounts that pursue various customized strategies that a number of the mainstream managers, from State Street to BlackRock to Prudential and others, have developed. Our investor network holds investor summits on climate risk and opportunity at the United Nations every other year, which we held this past January. We developed an INCR action plan that was approved by our board, which includes representatives of New York City and New York State, focused on climate risk. And there's several action items that I sort of commend to your attention for ways to think about addressing climate risk. First is analyze and manage climate risks and opportunities. We're trying to understand how these risks, how carbon risk might impact your portfolio now and in the future. Integrate climate risk considerations into external management, procurement, and monitoring. I was delighted to see your RFP includes 14 ESG questions. That is a leadership initiative, sending a signal to the market that a major asset owner cares about these issues and thinks they're material to investment outcomes. Investing in low-carbon solutions, some of the thematic opportunities that we talked about. Looking particularly at energy efficiency as an investment opportunity in buildings and other types of assets. Looking at water risk and opportunity for investments. Engaging companies on ESG issues, you're doing that. We encourage you to continue. Supporting national and international policies on climate change and clean energy. It really is going to take policy action to reduce greenhouse gas emissions. President Obama, in his inaugural address, has committed that that's one of his priorities. We regard that as a good thing and want to do anything we can to support that. And working with regulators on disclosure of material climate and sustainability risks. Pushing the SEC to do a little more enforcement of their climate guidance, send more comment letters to companies. They're doing a poor job on these issues. So in conclusion, and I'd like to take any questions or hear your thoughts, we think ESG factors are increasingly material to companies and their investors. Climate change in particular is having material economic impacts on multiple sectors and their supply chains. Climate change and other ESG factors create investment risks and opportunities. There are business opportunities in solving these problems. And you as trustees, as fiduciaries, need to understand and address climate and other ESG risks and opportunities in your investment process. And again, commend your sustainability, your ESG committee for taking steps in that direction, which we'll support in any way that we can. And NYCERS has an opportunity, which it looks like you're embracing, and we hope you'll embrace, to lead the way for other funds in these areas in ways that will be consistent with your fiduciary duties and maximize your long-term risk-adjusted returns. That's pretty much what I had to share. Would welcome any questions or comments that you all would have, might have.
We have a couple minutes for questions, if you have them.
Yes, sir. I thought it was an outstanding presentation. Very much. I was wondering, does your group do any calculations about this idea of weighing or measuring the potential impact of long-term ESG factors on kind of short-term decisions on returns? Like, is there some kind of way that you can look at that and balance it, or we need to start thinking about it in terms of it having a larger impact or a more critical factor in what you decide today? Do you have advice about that kind of stuff?
I mean, we address it at a conceptual level, but we don't do the modeling and the specific consulting. So we'd encourage you to work with your consultants with Cal on that. One of the projects that we're working on now is trying to bring together asset owners and their consultants around ESG as an investment risk and opportunity, and we're holding roundtables. We hope to hold one here in the city that we're hoping that the Comptroller's Office will work together with us on, as well as the State Common Pension Fund, sort of behind closed doors, the consultants and the pension funds to talk about how these issues can affect investment and what types of services and support the funds would like to get from their consultants. We held one with the Taft-Hartley, the labor funds in Washington right before the holidays, and had a really good discussion, and we're also going to do one on the West Coast. I think, having the investment consultants provide more support and analysis on these issues is a good way to address it. There are specialist consultants out there. There's one called True Cost that will do environmental and climate and carbon risk assessments of portfolios to try to get at how those risks may play out, both potentially this year, but they tend to be issues that require and benefit from a longer term time perspective. If you're just looking at quarterly returns, it's often hard to figure out how these issues, other than random events like Hurricane Sandy, which we now know can happen any time. So I hope that's responsive.
Al?
Yeah, we're going to make a statement and then ask a question. Rich, thanks a lot for your presentation. I thought it was excellent. And one of the takeaways that I got from this that I hadn't thought about before was the risk of weather events in other countries affecting us here. I mean, we understand the magnitude of these things when they happen, in the United States. But because of the global economy, these events can pose risks no matter where they happen.
Absolutely. In fact, I didn't talk about the example of the Thai floods, but not only your global equities portfolio, but in your U.S. equities, the supply chains. We've outsourced a lot of manufacturing to places like China. China is experiencing a lot of water issues, a lot of pollution issues. China is really ahead of the U.S. in many ways, both in greenhouse gas emissions and in trying to figure out how to come to grips with it. The floods in Thailand last year severely impacted 3 industries. The computer hard drive industry. It turns out a whole lot of the hard drives that are used in a lot of the hardware that may be on this table were made in Greater Bangkok, which is underwater. The textile industry, there's a huge amount of global textile supply, and garment manufacturing that was done there. And the third one, gosh, what's the third one? Hard drives. Blanking on the third one. There's a third major industry, auto parts. Particularly the Japanese manufacturers got a huge amount of their parts from there, and Toyota was really compromised in its ability to make cars. The Detroit auto manufacturer, I think I saw somewhere that there was $1.5 billion impact to either Toyota or Nissan from those flooding events. So the global supply chain is really important. If it's concentrated in a place that's vulnerable, it's hard to figure out a place that's not vulnerable.
And the other thing I got from your presentation, which it's kind of alarming me, is that these environmental risks are very similar in my mind to the whack-a-mole, where it pops up and then you hit it, and the game starts out slow, where we're having things pop up like this, but as the environmental situation gets worse, they're just going to be popping up much faster, and they're harder to hit. So what I'm getting at is I like this idea of an environmental risk assessment, because things are, from my perspective, things are only going to get worse, not better. We're going to have more of these events, not less.
Science is respected too.
Right. So could you talk a little bit more about the environmental risk assessment?
Sure, yeah. So I think you're
portfolio?
right. It's scary. It's a giant uncontrolled experiment with the climate, and we're just seeing the leading edge. This is 1 degree of warming. I don't think a lot of funds have really done this yet, but I think there are consultants out there. We can try to help identify them who can look at climate sensitive assets in your portfolio, look at the amount of carbon and fossil fuels that are present in the portfolio. Not to say that, let's go divest those, but at least to provide a structured way of thinking about where those assets are, how they might be impacted, and what might be a 3 to 5 year strategy of asset allocation. I think Jane Ambekshire may have talked about some of this, but Mercer in the climate change area did a study in which they said that they thought there was sort of a 10% sort of valuation risk to portfolio from climate change over 20 years. I think they severely undervalued that because it was really all about regulatory risk and uncertainty, and not, they minimized physical impact risk. And then they looked at asset allocation strategies that you could use to, in effect, hedge those risks or invest in solutions. And interestingly, Mercer has now developed an alternatives fund that they're putting together. I'm not here to sell Mercer's fund or any asset manager's fund, in which they're trying to act on the strategies that they recommended in that report, and put together a fund that, if you'd ask them, well, what should we invest into to address climate risk? They'd say, well, these strategies, these managers, these asset classes. So I think it might be a good idea to look at both the risk side, and then maybe to look at opportunities, where some thematic opportunities might be, or what could you do in your equities portfolios and your passive strategies, and what options would the fund have to address some of these risks and maybe capitalize to a greater extent than you might be now on some of the opportunities. Just to start out by thinking about how these issues might be addressed. And we're not saying go disinvest in any particular sector today, but I think it's time to start thinking about what the risks might be and what the opportunities might be. And from purely a risk-adjusted return standpoint, how do you want to position the fund, 3 years out, 5 years out?
Well, thank you, Chris. We're out of time, but thanks for a very interesting and educational presentation.
Well, thank you very much for the opportunity. And we support the steps that the fund is taking, and would like to be any help we can.
Terrific. Thank you.
Thank you.
Good stuff.
And now that ends the public session for today. I need a motion to enter into executive session. Do we have a second? All in favor? Opposed? Okay. So the plan is to